Good afternoon, everybody, and thanks for joining us today for our markets update webinar on the headwinds and the tailwinds facing us for the rest of 2025. Most of you know me. My name is Jonathan Sheahan, and I'm the Managing Director of Compass Private Wealth. And I'll shortly introduce you to Pat Holohan, who's joined us recently from Cork, who'll be giving the bulk of the presentation today. So thanks to all of you for joining us. We're hoping to be done within 30 minutes, so we'll be wrapped up by 2 o'clock. All of you guys are attendees on Zoom. You're all anonymous to each other, so nobody can see you. You can submit a question to us. It's only Pat and myself that see the question, so there is a button on Zoom that you can submit questions to us, and it's only Pat and myself can see the question and see who it's from. So please do. Any questions that pop into your head, send them to us and we'll endeavour to answer them during the session or at the end. As you know, this is being recorded, so we'll send on the recording afterwards, and this is quite a technical webinar, so a lot of the slides you may wish to look back at or listen back to the recording or pass them on to any colleagues or family members who might be interested. So we will send on the slides afterwards in PDF format because there is a bit of detail to some of the slides, and it will be good to give you guys the opportunity just to spend some time looking at some of the data and some of the analysis that we prepared for you today. So as I said, I'm Jonathan and I will be joined by Pat Holohan. So without further ado, I'll go through the agenda. Because we're mid-February, we're just going to give a brief overview of where we were in 2024 and what happened with markets. We'll then look ahead for 2025. And we did give a theme today of the headwinds and the tailwinds, or what they call the bear and the bull factors with markets. A headwind is obviously anything that will slow down economic growth or markets, and a tailwind is a positive that will help us. So we're looking at a few different themes, and within each theme, we'll give the pros and the cons of the bull and the bear factors and such. The first would be a recession. Yes, no, or maybe. We're then going to discuss the stock markets. Yes, we're at all-time highs. Are we at a bubble? Are things expensive? Is there opportunities there? And finally, we're going to discuss the US and the impact of the US on global markets and how important the US is in the Trump theme for global markets. And finally, we're going to just summarize and say, well, what does that mean for you guys as our clients in terms of your pension funds or your non-pension assets or whatever it might be? What does all this mean for investing? And then we'll conclude with a Q&A at the very end where we'll endeavour to answer as many questions as possible. So without further ado, I'll pass over to Pat Holohan.
Hi everyone, thanks for joining us today in your lunchtime. And I suppose one of the things that I wanted to look at when going back to 2024 is just take a step back. And if 12 months ago, we had said there would be US election turmoil between Biden dropping out, Trump suffering 2 assassination attempts, Harris leading the polls right up to the end, big swings in where expectations were there. We also said that Iran and Israel would get into conflict for the first time directly, and the wars in the Middle East and Ukraine would keep going, that interest rate cuts in the US would actually only fall to about a 1% actual cut versus 1.5% expected. Germany and Europe would fall into recession and there would be ongoing political European struggles. The US would have recession fear slightly rise and causing markets to fall mid-summer. And that the so-called Magnificent Seven, or the AI companies, would stall their growth, and that actually would only become 2 or 3 by the time the second half of the year pushed on. And if we all knew that 12 months ago, what would we do and where would we have positioned our portfolio? And I think a good lot of us would have been a lot more cautious on where we would have been. So the reality is stock markets didn't care. If you might move on to the next slide, Jonathan, please. The global markets were up 17%, led by the US guys, 23, 28% in the S&P 500 and NASDAQ. But more importantly, what I'd like to do is focus on the right-hand column here. The right-hand column is basically what tends to happen in markets normally. And last year was no different. We had an 8.5% drop during the summer last year, and that actually falls between the first two bars. So what we're looking at here is since in nearly 100 years of the S&P 500, 95% of the time markets fall by 5% or more. And in fact, if you look at the second column, the markets drop by 10% or more 64% of the time. So that's more often than not, if you were to phrase it as such. Last year was right in the middle of those two guys. So it was a fairly normal market with very strong returns. So market volatility does happen, and 2024 was no different, but nothing that we would be overly concerned about. Next slide, please. Yeah. But it's also important to understand where the growth in stock markets has come from in the last 4 years or so. This table is a little bit busy, but if we were to focus for a second on that second column, or America, this is US market growth over the last 4 years or so. The green on these bars is what I'm going to call good or positive growth. That is actual earnings growth backed by share price growth, and it remains the majority of the performance. The red and the black is what is causing people a little bit of concern at the minute, and these are the frothier components. And the light kind of red line is the performance of what's called valuation change. So this is where people pay more for the same thing, and things getting expensive. The darker black bar is FX, or foreign exchange, in these markets. And sorry, in the US, there's certainly a bit of that heat built into their currency price at the minute. But you can see from the Eurozone and Japan, the Eurozone has carried a negative performance from valuation change. And in Japan, the currency has been a detractor for performance. But really, the big thing I'd like you to take away from this is a lot of the strong performance we've seen recently has been built on actual earnings growth, companies making more money, so share prices have gone up. So one of the big things we'd look at is, should we be worried today? There's an awful lot of noise out there and awful lot of uncertainty. The news cycle seems to be getting even faster, particularly with Donald Trump. And how are we going to react to that? And the next slide shows you the performance of stock markets over the last, 15, 16 years or so, since 2009, where there's always a reason to be concerned. This slide is very busy, but it basically shows 800% performance in the S&P 500 with lots of news information flowing off it. And that covers everything from earthquakes, nuclear issues, government policy failure, viruses and the pandemics of COVID, economic uncertainty in Europe around sovereign debt crises, through to storming of the political capital in the US, bank failures. It's all built in here, but the market just did not care, and quite often it doesn't care. And I think it's something that we are facing at the minute, where there's a huge amount of news being thrown at us and an awful lot of concern being thrown at us, but quite often markets don't care, and that's certainly playing out as it stands right now. There's a particular index called a fear index, or the VIX, the VIX, based out of America. And it's actually gone down in the last month or so, and it's not rising despite all the headlines and all the concerns that are out there. So moving on, I suppose that's kind of 2024 and a quick review. What are the major concerns and risks going forward? And one of the questions we get asked a lot is a recession pending, or where are we on that cycle? And right now, the overall picture looks good. None of the top 45 economies are expected to go into recession in 2025. In fact, most observers think we are in an acceleration phase. So 2025 being the far right-hand column here, and the darker green being an acceleration rather than even just more normalized growth. And the reason for this is that, first of all, Trumpian policies are expected to be very pro-American growth. And what we're actually seeing is the rest of the world now responding in kind and trying to support domestic economies through action of their own. So, for example, this week alone, France announced about 100 billion euros of an investment in artificial intelligence. Last year, China announced a 1.4 trillion stimulus package for their own economy, focusing on trying to fix their property markets and protecting their domestic demand. And what we're kind of seeing is a reaction to Trump's policies, forcing governments to sharpen their pencil a small bit and think a little bit harder and better about what happens next. So moving on, the IMF, for what it's worth, has global growth for 2025 actually very similar to 2024 across most regions. And while I'm not so sure there's much to write home about with 2-3% growth, it is still growth. And it's very unlikely that there will be economic recession in 2025, if you were to believe what the major economists are saying. But the big risk to all of this, what most people seem to come back to, moving on, Jonathan, thank you, is inflation. We have seen that this graph here is a 10-year Treasury chart, and what has happened to that interest rate or the expectation of 10-year money in America since Trump got into power, or since he was elected, more to the point. We've seen a 0.75% uplift in that cost of money. And so what this is basically telling us is markets are now pricing that rates stay higher for longer on the back of higher expected inflation. And indeed, yesterday, the US inflation number came out for America, which suggested that January inflation ran at a rate of about 3%, which was higher than expected. And as per his style, Trump is trying to blame Biden and calling it Biden's inflation and different things like that. So that remains to play out. But I think inflation continues to be on the table. But how much on the table will hopefully be presented in the next two charts. So this is the ECB's forward rate curve. So this is the expected interest rate journey that we'll all go on for the next 20 to 30 years. And what you're looking at here on the left side of this chart is the interest rates dropping, which is what's happening in Europe right now as the ECB tries to stimulate European economies and try and drag Germany out from its doldrums, followed by a period where it returns to normal. Obviously, as you go further out, the relative level of detail you have is harder to gauge. So we kind of get this smoothing out of curves as you hit kind of year 10 onwards. But what's notable here is that while this chart looks like there's a big dip and then a swing upwards, we're talking about, within this chart here, an interest rate of between 2 and 3% at most. We are entering into a period, it looks like, where things are reasonably benign. Moving on, you could say the same about the US. And again, this is the US same curve, but you will see that there is a little bit of a difference, and that's that short-term rates are expected to actually stay flat or go up. And this chart is a little bit misleading because it's on what's called a log scale, but basically the first 12 months are on the left-hand side, or the first half of the column, and then it pushes out into longer end stuff further down the line. So basically what this chart is telling us is that in the US, they think rates will either slightly go up or stay flat for the next 12 months before they then start to rise towards that higher 10-year rate. Right at the start of the year, there would have been expectations that you would have seen 2 interest rate cuts in America this year. Right now, the average expectations were down to 1, and even some commentators are saying none. And that is all based off inflationary data. The US are concerned about this, not so much from a consumer point of view. They feel the consumer in America is strong, robust, and has very low debt. They're actually more concerned about it from a government level, where there is a big wall of money to be refinanced in a few years' time, and they want to try and get interest rates down as low as possible for that. But again, it's all headlines. At the minute, if you log on to the Financial Times at any one point in time, they're talking about the price of eggs and avian flu and all the things that Trump said he swore to do. Now, the next phase of this is actually, so that's quite a lot of that is backward looking. And what we don't know here is the impact of Trump's tariffs and policies on immigration. And things can change a lot, obviously, when it's dealing with him. But there's no doubt about it, the tariffs are inflationary, certainly when you consider the reaction from global governments so far, which has been to respond in kind. The question remains as to whether his bark is going to be worse than his bite. Mexican and Canadian concessions quickly after their announcements suggest it's going to be the latter. But have no doubt about it, the impact on tariffs on the US economy is inflationary, particularly if a strong dollar continues. If you just go back 1 second still, Jonathan, please, sorry. The other big issue within America is the immigration and the impact that has on labor-intensive economies such as farming and in construction. There's already anecdotally lots of stories about farms not getting worked at the minute because people are just staying away from work out of fear of being caught up in his immigration policies, and also the impact on labor, particularly say LA with rebuilding houses and stuff like that. Moving on, the other big question we get at the minute is around stock markets and all-time highs. Should you be investing today and what should you be doing? The reality is all-time highs happen all the time. We had 50 all-time highs last year. This is on the back of an 8-year consecutive run that ended in 2021. There was 70 in 2021. They're a regular and frequent occurrence. And moving on, you'll see the reason why, which is quite simply markets are meant to be at all-time highs. If earnings are going up and earnings continue to grow, then you'll get markets going up as well. It's simple as that. And that big dip there towards the right-hand column is the global financial crisis. And you can even see a smaller dip later for COVID reasons. But ultimately, markets go up, earnings go up, and everything keeps in lockstep. And the best example I can give of that is NVIDIA, the poster boy of AI, is up 17,000% in the last 5 years or something like that, and their earnings are up at the same rate. So again, moving on quickly, Jonathan. There is undoubtedly an expense built into markets at the minute, though. These are a list of some, but not all metrics by any means that you could look at to value the S&P 500 right now. The PE is running at about 24 times earnings with a long-term average of 18. The price to book, the price to sales are all running higher. Dividend yields are lower, earnings yields are lower. And the one that Buffett would have been famous for in the past is the market cap to the value of the economy is quite high as well. So this is basically saying the GDP being an indicator for the current economy, the market capitalization being an indicator for the future economy, and what's the ratio between them. And right now that ratio is quite high at about double, whereas the long-term average is about 125%. So there's a premium built in there. The last part on markets, as we get towards the end here, is are we in another tech bubble? This is a table of the Magnificent Seven, as they're currently called, relative to other bubbles that would have happened in the past, both in tech and financial and other forms of bubbles. And right now, at 24 times earnings, it's not that expensive relative, say, the tech bubble of the early 2000s, which was about 52 times earnings. The one point of concern I would hold here is the relative market weight, which is the top left-hand indicator on this screen here. At 31% of overall markets, these guys are punchy weighting. So while I don't think there's a bubble to burst per se, any kind of slip off or fall off in earnings could see these guys impact markets more so than other sectors. So just keep that in mind in terms of your portfolios. And then lastly on markets, we're not at a shoe shine boy event. I don't know if you're familiar with this, but this is the story that if the guy in the street is telling you to buy something, we should all be running for the hills. More money went into defensive assets last year than equities. And that's a lot of money waiting in the sidelines. In America, there's a just cause for this. You can pick up 5% on your savings in America, or 4.5%, which might be a nice earn while you're waiting for things to settle down, particularly in the Trumpian period. But the vast majority of money is still not in equity markets. There's a huge amount of money in the sidelines, and in time that will flow. That will shift and change direction. And then lastly, bull markets can go on for a long, long time. This chart here, the red line is the current run in stock markets, but this compares it to other bull markets going back in time. There's about 13 or 14 of them on this chart here. There's a long way to go, potentially. They can stop at this point, but they can also go longer, and you need to bear that in mind when you weigh up all the different bits and pieces that we've been considering here today. So the last point I wanted to touch on, because there is a reason why we've been US focused so far in this presentation, and that's because America is now 73% of global markets, but others do exist and they have their own positives and negatives. In Europe, markets are cheaper across most metrics compared to that table I showed on the S&P 500. And there is a light beginning to shine on them now. German markets are up about 9% this year, even though they are dominated by importing and exporting companies that you would otherwise think would be impacted by tariffs. But again, politics is a risk. Germany and France will have elections as their voting seems to move to the right. Overnight, we were told that Europe is being excluded from the Ukrainian talks between Russia and the US. But so far, the reaction to Trump, has been quite positive, and has been starting to refocus the mind as to what the European project is. China, on the other hand, has had a volatile stock market. Last year was a very positive time for them, but there were volatile swings. It had both a 15% swing down and up within the calendar year. They had a huge stimulus package, as I mentioned earlier, about 1.4 trillion put into the market, which actually disappointed, and they are concentrating on trying to fix their their property market. One thing to note about them, and something I'm kind of watching in the sidelines, is they are a hugely active buyer in gold, and the idea here is that they build up independent fiscal security in the event of a geopolitical risk of them getting cut off. Similar to Russia was back when they invaded Ukraine, and also they are a very significant holder of US bonds, and they're actively selling them, which is why rates have been going up. So that was a very quick run of the houses. I'll hand you back to Jonathan, and we see where we go from there. Thanks.
Thanks, Pat. And I suppose the key takeaways for everybody so far is, in my opinion, diversification is still the most important thing with any portfolio. At any one stage, there's positives and negatives in a market environment. But one thing I think is very important to remember is that I wouldn't correlate what's happening in markets, what's happening in economies, what Trump says or does. I wouldn't correlate that with your portfolio performance, because there's a significant amount of noise out there at any one point in time, as Pat's slides alluded to. And sometimes counterintuitively, a positive news can be negative for markets, and negative news can be positive for markets. So we've seen that over the years with, you could see GDP growth could be worse than expected, and one would expect that stock markets would react negatively to that. But sometimes when GDP growth is lower, there's a higher chance that the central banks and the economies will engage in stimulus measures, and that can actually be a positive. So sometimes negatives are positives and the other way around. But always the most important thing is long-term strategy. There's lots of negatives and lots of positives at any one point in time. But the key point to remember for investors is that you need to think long-term. The chance of stock markets or your portfolio being up and down in the short term is always close to the toss of the coin, 50-50. But over the long term, by having a robust investment strategy in place, one would always expect equities to outperform other asset classes such as cash. So we have a few questions coming in. We just have two more slides that Pat's going to go through, which discusses time in the market rather than timing the market. And then we'll wrap up just before 2 o'clock with answering a couple of questions that have come in.
Okay, so very quickly here in these things, because I am conscious of time. Apologies, sorry, a few things are popping up on my screen here. So this chart here basically shows how difficult it is to lose markets. Well, it's a very busy, and I'm happy to take people through this offline if needs be. Ultimately, green on this slide is good. And so what you've got across the top is your year of starting investment, say. And if you run it all the way down, you can see the likelihood as time goes by of you losing money becomes lower and lower. You do need to be careful and match it within your portfolio. But I like this quote from Warren Buffett, which is apologies. I like this quote from Warren Buffett, which is basically the stock market is a device to transfer money from the patient from the inpatient to the patient. Which, and basically what he's saying there is, if you start an investment plan or if you're invested today, and things go a little bit wrong at the start, time will work in your favor, and take your time with it and be patient. Next slide, Jonathan, please. And the next slide here is just basically about discipline in the market. This shows 18 years of returns in stock markets in the S&P 500. And if you put 10,000 euros or $10,000 to work in, 28 years, apologies, 1980, and left it there until 2018, your investment, if you did nothing, was worth about $660,000. If you missed 5 of those days in that 18-year or 28-year period, just 5 out of 28 years, you would have halved, or sorry, would have about 2/3, all the way down to if you missed 90 days out of the market, and these are the best days, it should be noted, your return absolutely collapses. So what I suppose we're trying to say here is, if things go a little bit awry in 2025 or 2026, let's not panic and let's not throw the baby out with the bathwater. Stay the course. The plans will work out, and things will fix themselves in time. The big question and the big thing that Jonathan and I and the rest of the Compass team would be looking to do is to work with you to make sure you're at the right risk levels for what you want to achieve.
Thanks, Pat. And just before we answer a few questions, this is just a one-page snapshot that summarizes the Compass Private Wealth business model. Hopefully all of our clients on the call are familiar with this, but then we have a few others who are on the call as well today. And it's just very simple, 3 strands: investment management, pensions, and financial planning. Everything we do is tailored to our clients, which is the first point here, very important. We like to be proactive rather than reactive. Anticipate what our client needs are, anticipate changes in legislation and investment markets. We always have a long-term focus, short-term pain for long-term gain, as I say, and absolute fundamental to everything we do, client first. That's the number 1 rule with Compass Private Wealth. So thank you, everybody, for your time. Quick question for you, Pat, from client. Warren Buffett has been raising some cash recently. What do you read into any of Warren Buffett's movements at any one point in time, or does it matter?
Okay, there's 2 parts to that I would take. Clearly, he's a far smarter man than me, and him putting money into the sidelines could be an indication that things are expensive. There's one thing I would say and take it up back. While he's increased his cash weightings, he's not out of the market completely. And I think that's an important thing to bear in mind. So he's adjusted his risk levels. There is talk that he's considering a handover and he wants to give the next person in power a war chest. But I think it goes back to those slides that are there. He's seen his indicators that he looks at. Flash orange, and for him that's an indicator, if he's a disciplined investor, to take a small bit of money off the table. I think his big changes were to sell down a bit of Apple and I think Bank of America, and to reduce his holdings there, not to sell them completely. And I think he's waiting for a chance to go again with another bit of capital. But I would also stress he's not sitting in total cash. He will have some investments out there.
Guys, we've got a few other questions. We don't have time to get to them. We're just at the half-hour mark. A big thank you to Pat, and a big thank you to all of you guys for taking time out of your precious lunchtime and joining us today. We will send you the slides. We'll send you the recording. Thanks very much and enjoy the rest of your day.